Hello, Culture Matters podcast. I am excited to introduce you to our guest, but before I do that, here is a quote just for this episode. Even if you're on the right track, you'll get run over if you just sit there. Will Rogers, our guest today, is a friend of the Culture Matters podcast, one of our advisors, somebody that I am learning from and have been introduced to people that really deeply matter in my life that you've heard on the show before, the one and only Peter Spergel. They've been helping people build their success, not just in their businesses, but in their actual personal balance sheets, the wealth of their families. For over a decade now, I believe they've actually been a high performance athlete in their life, which is a small percentage of human beings, which is why I picked this quote from this famous baseball player. Played in college, played for the Astros. They were a pitcher, I believe. We're going to talk about that a little bit. And Mike Modica, senior partner at Pine Valley Wealth Management, our personal CFO, is here to join me today on the Culture Matters podcast. Very excited. Thanks for coming on. I know this is exactly what you want to be doing midday.
Hey,
uh,
it's election day. It's all good. It's a nice lunch break.
Thank you so much. So, yeah, first, I'd like your curiosities on this. There's a reason I picked Will Rogers because there's this book that Buffett said to listen to once. Now I'm forgetting the name of the book, but Will Rogers actually wrote a book that is about swinging or not swinging. Something around investing is how it was used. This Will Rogers character. So, what do you think about this quote? Even if you're on the right track, you'll get run over if you just sit there from an investment standpoint, from a building wealth standpoint.
Hmm. Well, the first thing that came to mind when you said the quote, which we had not rehearsed, I didn't know that was the quote, was my baseball brain went off. And there's a movie called Major League, which is like one of my favorite baseball movies, but I can't remember the guy's name. He was the bad guy, and he runs over the catcher and he says, don't stand on the tracks when the train's coming through. So that was the first thing I thought of. I have not made the translation to wealth management. I suppose it means there's always something to be working on or doing.
Hmm.
Um, so yeah, who was so it was Rogers that was the quote?
Yeah. Now, Will Rogers, this is sharing my ignorance. He was a baseball player, correct? Wasn't he a good swinger? Like
I don't know. I don't know.
Will Rogers? Yeah, wasn't or am I getting that confused with another baseball? That might be showing my ignorance. There's this book. Yeah, it's like it's about I want to share. It's about Buffett talks about all the time where it's about not swinging in every pitch. He had this strike zone
Yeah,
and he didn't swing at every pitch. He had a certain area where he would
yeah,
swing the bat and he just his art it was it's the book is called it's coming to me right now. The Art and Science of Hitting, I think. And it was like he wouldn't swing at every pitch. He had a certain zone of competence. And Buffett and Munger talk about staying in one zone of competence.
yeah.
And this guy was a baseball player.
Yeah, so now it's ringing a bell. And did you watch any of the playoffs, any of the off season or postseason for the baseball games?
I did it. I did it.
Perfect example of what you're talking about, and you're spot on. Big league hitters, the good ones, they have a they have a sweet spot, right? Pete Alonso, I just had to look up his name, but he's the first baseman for the Mets. If you watched any of the postseason, you could see clear as day that Pete Alonso can't hit anything underneath his hands. So he doesn't even swing at it. But when the ball's elevated in the zone, he likes to stretch his arms out and he can hit balls out of the ballpark. And sure, he only hits maybe 220 to 240, but he hits a lot of home runs. And that's a guy that knows the pitch that he can handle, knows the pitch that he can hit. And when pitchers make good enough pitches and they can get it underneath his hands and in the strike zone, they can get him out pretty easily. So to translate this into investing, perfect example would be one of our portfolio managers. His name's Mark McGarian. Mark has kind of a top-down process that keys in on cash flow. And at any given time, he's very knowledgeable on 10 to maybe 14 different businesses or stocks. And he can list just about every line item across their balance sheet or profit and loss. And he has a sweet spot. There are certain types of companies that he can diagnose, and he knows when something is kind of outside of his scope or ability. And he'll be the first one to tell you that if it's a growth business and there isn't a ton of cash flow, and there's a story that gets matched with, the market and how the market is doing its price discovery, he'll be the first one to raise his hand and be like, I can't really contribute here. This is not something that I have a skill set on. So he that to me makes a lot of sense, translates a lot into baseball, translates into investing, knowing what you're good at.
This
And
is the embarrassing thing of me. It shows me as embarrassed. I just looked it up. It's not Will Rogers. It's Ted Williams.
oh, huge
He
difference.
he
Yeah.
wrote this book.
Maybe the best player of all time.
Okay, he wrote this book, Science of Hitting by Ted Williams. And yeah, it's called The Science of Hitting. I don't know. It's kind of so just I don't want, that was me. Will Rogers it's stuck in my head. Will Rogers, Will Rogers. Ted Williams. He was the best, you're saying? Or one of the best?
It's really hard to tell. I mean, if you look statistically at what he did, he's at the top for a lot of different categories, a lot of different stats. But he's got an asterisk on his statistics because in the middle of his career, I'm going to get this wrong, but probably when he was 27 or 28 years old, he left and went and fought in World War II.
Wow.
Right in the sweet spot of his career. And then he came back from the war. It wasn't 1 year, it was like a few years. He missed a baseball. And the year he came back, he hit 400. Yeah, it's just like it doesn't even make any sense.
Wow.
So is he the best player of all time? It's hard to say, but it's really hard to argue against. He's definitely up there, and you got to give him a little bit of credit for doing what he did,
Hmm.
and but there's 2 or 3 years there of stats missing from a guy that quite honestly could have been the greatest of all time without a doubt.
What what if anything has translated to business, running a business, advising clients that you may have derived from playing at a high level as a pitcher?
Um, Probably, I mean, work ethic is an easy one. But I think anybody's gonna have a certain level of work ethic if you have some sort of an entrepreneurial type job. Um, I think that humility is a big one. I was a closer in pro ball, for example, and I wasn't necessarily a closer. I was a seventh, eighth, or ninth inning guy. I would pitch in, one of those innings. So I was throwing in the late innings of games. I was a starter in college, but in pro ball, I ended up pitching out of the bullpen more towards the back end of the games. And those are high pressure situations. And some of the worst feelings that I've ever had is you're in an away stadium, visitor stadium, 10,000, 12,000, 15,000 people, and you blow a game. Or somebody hits a game-winning double or a game-winning home run. And you have to make this, what I think is one of the loneliest walks ever, from the pitcher's mound to the dugout and basically go into the clubhouse while 15,000 people are celebrating. And then you have to come out the next night and do it again and pretend like nothing happened. So I've done that. I had a lot of good moments and I've had some bad ones. And at the end of the day, I think it makes you a better person because it never really rattled me. It did rattle me for sure, you know, that first time, but you learn how to come back from it. In business, it's the same thing. I mean, especially if you're in sales, like you're not gonna sign somebody, or maybe you have a client, you lose a client. There's ups and downs. It's really just about how you handle them. And some people it'll fire them up, some people it'll kick them down. But I think baseball specifically, well, let me give you like a little bit of a path here. I mean, I was I was an okay baseball player up until I was probably like a freshman in high school. And then I was a stud. And then from that, freshman year to senior year, I was a stud. Got an offer to play in college, went to college, got to college, and I was just another guy, right? I was just another stud on a team full of studs. So I had to learn how to get better all over again. So freshman year of college, all the way to senior year of college, just another guy, just another guy. And then I got better. By the time I'm a senior, I'm a stud again, right? Great. Highs and lows. Then you get the pro ball. Now you're just another guy all over again. In single A, in double A, it's the same story.
Wow.
So you have to keep leveling up. And while you may not feel physically better, physically, I may have peaked in college, but you have to continue to level up mentally, physically, whatever it may be. And that's what I think it takes in business. You have to do the same thing, right? Otherwise, you're just standing on the track, standing still.
Were young, did you aspire to be in business at any point, or did that come later?
Um, yeah, I wanted to work in finance, investments from a pretty kind of early age, I think. I didn't really understand the business that I'm in now at all when I was in college. I thought it was, we were all investment bankers, and um, it wasn't until I got kind of my first job after I got done playing baseball that I kind of understood this business and how entrepreneurial it is. I didn't have like training or anything like that, so I kind of had to learn a lot of it on the fly. I don't have like your normal traditional path that most financial advisors have. A lot of them will start at, some of the banks like a Merrill Lynch or Morgan Stanley, and get some sort of formal training. Mine was a lot more traditional. I started on the side of the business that I'm on now, which is the independent side. I worked with somebody that was a family friend and learned a lot of like, basic skills and like financial planning type things before we even got our hands dirty on the investment stuff. And that was kind of how I built like my foundation. But I was always attracted to it. My dad was always somebody that um was very engaging with me with money and investing and having those conversations. And we would talk about Jim Simons or Warren Buffett, or, my dad was an engineer, so he wasn't
Wow.
really a finance person, but he kind of saw where I was gravitating to, and he kind of, fed that flame a little bit. Um, so yeah.
Now, we're not giving financial advice, but what I would like to, as a disclaimer for our listeners, what I would like to understand more so is how to screw it up if I'm a client. And I mean, maybe that's a little aggressive way of saying, but if I'm a client, I want to start thinking about the future and building my wealth and
Yeah.
success. What are some quick ways or quick examples or behaviors that you'd say in your observations over, your career that you've seen people undermine their likelihood of building wealth?
Um, So are you asking from the perspective of somebody that's already a client, or if somebody was just working on their own?
Oh, well, I'd love to go do the two different scenarios. Start with the one that you'd prefer to start with. That's a
Yeah,
great.
I mean,
I think we should speak to both
if,
audience.
yeah, if you didn't know me and you weren't working with me, and just some kind of general thoughts, um, I would say the most important thing, and I think this was Charlie Munger, who I know you love. Um, made a quote. I don't know how long ago it was, but it's stuck with me. I find myself saying it like a couple times a week. It's, do not or try your best to not disrupt the compounding,
Huh.
right? And what that means is like you need to know whether you're investing or trading. Because if you're investing, returns can take 10 years, they can take 15 years. But as you are aware, compounding is one of the wonders of the world. And, that's how some of these guys have built their fortunes. Trading is different. You're in and out in a day or a week or a month. That's an entirely different mandate. It's not the same, right? A bad trade turns into an investment because now you've got to hold it, right? So that's one of the mistakes that I think people will make. So have a clear path on what you're trying to do. If you're investing, that comes with a time horizon, right? And that time horizon, you need to be patient enough that you don't need to disrupt the compounding that you're putting in place with your investments, right? And getting into which investments you pick is an entirely different story. But let's just say, generally speaking, that's the mindset that you have to have. You can't open a brokerage account, buy a SPY or QQQ or whatever you're going to invest in, and then check it every day. It just doesn't work that way. That's gambling. That's trading, right? So knowing the difference, and you certainly can trade, like, don't get me wrong, but that's a 9 to 5 job. It really is. You can't, otherwise you're just swing trading and gambling. That's totally different. Nothing wrong with it, but understanding the difference is the biggest disconnect that I see people make. They think it's all easy, quick money.
Really?
Yeah. Some people, a lot of people get it, but some people, they think it happens overnight.
Someone that's listening is never, let's say they have never brought in third party advisory, you know, collaboration yet in their career, their business. What are some questions or that you would advise them to ask, or how they could look into that due diligence process of?
Um, well, just one more thing on my previous note. So like I
Sure.
saw, maybe it was on Twitter, it was like a screenshot of the S&P 500 in a chart. And the chart was 100 years, 120 years, whatever it may be. So if you zoom out and you go to Google right now and you type in S&P 500 chart, it's since inception. It just looks like, straight up and to the right because it's zoomed all the way out, right? And the woman who posted this on her Twitter, it was so funny. It said, I'm going to write a book with this image on all the pages. And at the top, it's going to say, shut up and wait.
Huh.
And I thought that was so good because it just makes sense. What was your question again? I'm sorry to interrupt.
What something, no, that was very helpful. Something that those that have never, for whatever reason, they either didn't feel ready or were told that's not the route to go, to bring in, to include others in that journey of investing, third
Mhm,
parties. They, for whatever reason, they've never had advisory, or a team as it
mhm.
relates to that attention. What questions, or how to go about doing due diligence? Because it seems as though
Yeah.
there's an overwhelming sea of those interested in doing that for people. At the same time, in our culture, and this could be my own bias, a lot of people I come across either don't know, don't trust help, don't know about it, don't think they're ready. Like there's a lot of it seems like there's this big gulf
Well,
between.
it's the question. It's an interesting question. I'm going to try and approach it from a few angles. Um, I think sometimes people may think they don't have enough money to get started. which is not the case. There's always advisors out there, especially at our firm. We work with, all shapes and sizes. The other thing I think people get hung up on are fees, which quite honestly is like a very easy conversation for me because it's very transparent. We don't make any commissions or anything like that. And I think where people get hung up on fees is like, it's not always about investment performance, right? We might give advice on some taxes, right? That maybe help you save some money on your investments, right? Like maybe there's some tax loss harvesting that you're not doing that you could be doing, right? That attributes to the value. We might give you some advice on structuring of your accounts, right? Maybe non-qualified accounts or IRA accounts or whatever it is, what you should be saying. Maybe we're communicating with your accountant or your CPA and putting more money away so that you pay less money in taxes. Like all of these things advisors can do to bring value. And I think a lot of people, it's all about investments, right? And I can be the first one to tell you there is no crystal ball. I can't tell you if the market's going to go up, down, or sideways, right? All I can tell you is over 120 years, it's pretty much grown at a certain rate, right? And that rate is better than cash. So if you want to hire somebody, that's kind of the general thesis. And I think people are blind to some of the other value add components that advisors can bring. Me personally, like I get my hands really dirty on cash flow, right? Thinking about a client in terms of like a business. When I look at a client, I think of them as like a profit and loss. Of course, we have their balance sheet, which we need to build out, but I also need to look at income and expenses, and I need to see what cash flow looks like, because there's probably a chance that if there's a surplus, maybe we could be saving more. If there's a deficit, we need to figure out how we're going to get out of that deficit, right? That's what I'm really good at. That's what I like to do. I have a CFO kind of mindset. You know this, I've told you this. And then some folks are really good with like planning. They have great ideas for maybe estate planning or structuring, those sorts of things. So when you're talking to an advisor, I think it's important to kind of ask them what they're good at, right? Because there's a bunch of different things and nobody's a jack of all trades. And people should pick advisors that they want to work with that suit their needs. All right. Let me know if I'm getting off track anywhere. So, our firm, I think we have about 25 or 27 different advisors, registered advisors. And I feel like everybody has somewhat of a different discipline. Everybody has a different process. Everybody leverages technology in some way. We don't use just one program because clients sometimes demand other things. Advisors might gravitate towards other things. But the technology nowadays that we have at our fingertips and the way that we can visualize it for folks is like endless. The only gripe that I have with our industry is that it's just a little fragmented. I wish there was one place that kind of did everything, but it doesn't exist. I'll pause there.
It's the ninth inning. You throw the pitch, the person hits it out of the park. You lose. You're walking back to the the dugout. A pro athlete might show up the next day. It's me throwing that last pitch for my kid's little league game. I might never go back to watch a game. The consequence of that, who knows what that would be for my kid. This metaphor makes me think of, it's like 2008, whatever, 7. We've all lost the game.
Mhm.
There are some people that decided to they had bought higher and now they sold low.
Mhm.
And there are others that, for whatever reason, decided the next day to go and play again.
Mhm.
Not everyone's an athlete. So how many of us are going to be able to do that without help or without somebody
Yeah.
to call and talk things through and to have that plan? I
It's a
would see
good,
if maybe you could help me land the plane, but like I have this vague metaphor that came to mind based on your
you're landing on the right runway. So, um, what I was talking about before, some of the value that advisors can bring, that's quite honestly very hard to explain. I wish I was better at it personally. Um, a lot of times people think we're overpaid, and sometimes we are, and sometimes we are wildly underpaid because we actually operate as like therapists and psychologists. A perfect example was in 2022. I don't know if you remember, like January 1st, um, basically we had inflation that just ripped its, roared its head pretty violently. Then we have Russia, Ukraine, all of these different things, somewhat of a perfect storm, and markets got hammered. I think we were down like 18 or 20% that year, the S&P 500. That year for financial advisors can be very difficult because, yeah, you're talking about portfolios. Yeah, you're making adjustments to financial plans. But you are talking to clients as a therapist, because if you weren't, they would be making some very bad decisions. They sell at the bottom and they buy at the top. And our job as the therapist is to try to reduce the amount of times that happens, because we
mm.
because we have a plan, we can see the plan, and we have to reiterate it to them, explain it to them over and over and over, and that is a big part of what we do. And that is the part that is very hard to quantify with a fee, right? Um, I can't tell you how many clients I had in 2022 that trusted me and gave us more money or invested more money that they were earning, they were making, because we had a plan. We were following the plan. We were buying equities, we were buying securities at a discount, right? That's the way you have to think about it. You can't think about it like the sun's never going to come back up. Of course it is. So, um,
It makes me think of like if the employees of a widget factory could see the stresses of those in the ivory tower, but didn't understand it, would they show up to work the next day? And the answer is maybe they wouldn't, unless they believed in the company.
right.
They believed in the management. Like the employees are just walking out because why am I going to show up for work today if the factory won't be open tomorrow?
That's a good point.
There's this degree of what trust or faith or belief.
Yeah.
How about characteristics of the more successful business owners that you've come across in your career? Because there are a lot of very successful people that you work alongside of. Characteristics of the people that really win. Because our listeners,
Mhm.
they want to learn, they want to win, they want to build success, they want to do it in a way that's valuable, meaningful, but also our listeners are entrepreneurs, operators. A lot of the guests of the show listen to the show. They're movers and shakers. What are the attributes that you've seen of those that really excel at a high level? They're kind of firing on all cylinders.
Well, so I kind of I put clients almost into two buckets. There are folks that are employees that are high earners for a company, and then there are folks that are business owners, right? And obviously the ceiling for the business owner is always going to be much higher. But I have quite a few folks that are employees that work with companies, and they're very highly compensated, and there is a delta between the two, but the difference is there's a huge difference, right? I think I see a common characteristic would be they are very disciplined. And discipline is doing what you hate to do and pretending that you love it, right? That's what discipline is, as Mike Tyson would say.
Huh.
Um, so a lot of the guys that I work with, there's some of the big consulting companies or big tech companies that make a couple $1 million a year. They pretend, right? They have discipline. They pretend like they make 200 grand. And that to me is discipline. Because they almost get addicted to saving.
Hmm.
Once we start doing their plan and when they may retire, how much they need to retire, they get addicted to it. And it takes discipline to be able to, they know what they're making and they pretend like they're not. Now, business owners, much less discipline, but a high degree of risk. And some of the wealthiest folks that I've worked with have a high tolerance for risk. And they're not afraid to place a bunch of bets.
Wow.
Yeah. And they have, they'll get their hands dirty on, some of those bets, like if they need to get something to the finish line, or if they need to work with their team a little bit closer and do 80, 90 hours a week, whatever that may be, like those people have a totally different drive and much less discipline because it's somewhat controlled chaos. Right. And then they're just like, all right, let's just add it all up later. Like that's their mindset and it works for some of them. And then they get to a certain point. Usually that's when they're coming to see me and I help clean it up. I like getting my hands dirty, like in that regard. But who am I to tell them that their chaos needs to change? That's what made them wealthy, right? They took a lot of risk. They tried a few different things. They placed some bets. They only need one of them to play out. That's a characteristic that, between those two. And then there's everybody in between, you know. So
How about red flags our listeners could be living out right now, not realizing they're undermining their wealth building? Like these are like the opposite of the Ten Commandments.
this is a
Yeah.
great one. This is easy. Now more than ever, it's probably super important to get a really accurate idea of your household's cash flow. Forget about your investment performance.
Huh.
Forget about all the other stuff. The first thing right now, get a grip on the cash flow. Money in, money out, and the net. Because everything is more expensive than it was 2 or 3 years ago. And a lot of people have not changed their mindset on things. And you need to pay attention to that gap, that surplus or deficit. And you have to develop some sort of a strategy to monitor it. And if you're making $1 million a year or $200,000 a year, it's the same thing. Use a tool. There's tons of them. Monarch is one that we use, but you need to get a really accurate illustration of your cash flow, not for 1 month, not for 3 months, but for several months. So you can start making decisions and find out where you're spending some of your free cash flow and trying to widen that gap.
Is part of that it's so important because if I look at the last few years prior to inflation peaking and some of the macro responses to that around the Federal Reserve and things, if business is going up, lifestyle creep happens, or scope, or business expense, and then if things are kind of settling back down, you have to reanalyze and reassess.
I don't think things settle down. I don't like, this is an opinion. This is not advice. I don't think prices go down that often. They level off. The rate at which they go up slows, but they don't go down.
Oh, let me clarify what I meant because I agree with that. I mean, let's say our business has grown a lot, and then and so our expenses have grown, and
Yeah,
then if business slows down for whatever reason until we can get it pumping again, we have to
yeah,
reassess our expenses to make sure we're not headed towards a cliff.
yeah. It's more simply the the cost of everything, inflation over the last 3 years has outstripped the the growth of earnings for households by 3 or 4 to 1, right? So the gap went like this. And people like they may feel it, they may not. My guess is most of them are. It really depends on how much money you make, right? If you're making a couple $1 million a year, you may not feel it. But for everybody else,
Mm.
you need to get a grip on it. Because if things go in the other direction, or you want to do this trip, or you want to do a pool, or you need to buy a new car, that next decision that you make could have an effect on the balance sheet. And if you adjust things on the balance sheet, guess what happens with the compounding for the plan down the road? That gets changed too. So I I I feel like I'm not doing a great job of explaining it, but I think it's really important. I think cash flow analysis at the household or the personal level is something that people just don't do enough of. They do a spreadsheet and they're like, oh yeah, Verizon and Wegmans, and they list things out. And it's like, it's not even remotely close. It was close maybe on that one day,
Yeah,
but
it's
next
interesting.
month it's not. So you need like, there's tons of software you can use for this. And I just think it's overlooked. And they make guesses on what their free cash flow is or how much they can save. And they're like, oh, wait a minute, I have to pay taxes. It's like, well,
Oh, that was going to be my next question. Wait, are we counting taxes in that?
I personally
Yeah.
record taxes as an expense for my household. Yeah, absolutely. Yeah.
So
Money
have
in,
you
money out.
seen scenarios where
Just because
people
some people have it
genuinely forget?
withheld, just because some people have it withheld on their paycheck doesn't mean it doesn't exist. They're just paying it for you.
Mm. Yeah,
Well,
can entrepreneurs that don't take these steps, these proactive steps that are new to the business, we have newer entrepreneurs listening. They get surprised. They might forget, oh, I have taxes now. I'm a real estate agent and I made,
yeah.
you know, I sold 10 million of homes, but I had to put a certain amount away to the side for taxes. And I didn't know that.
My advice to them would be pretend like you're making 50% less. Yeah.
It's a
I
good heuristic to stay responsible.
just take 50% of every check that hits your account, every ACH or wire that pays you, and just sweep it to the side and try not to touch it until you get into a rhythm with your accountant and your taxes and so on and so
How
forth.
about our listeners that, when you said earlier, if you're making a million a year or 200,000 a year and they thought, well, shit, let me tune out, you know, not, that's way out of reach for me. They're making 40 grand a year. Can they have an American dream?
Of course.
Like, does
That,
it does an IRA, make a difference to them? What is an IRA?
well, they have to be saving something. Um, listen, like, my dad was a single income earner. He put away money for himself and my mom. And there were 2 kids, and he wasn't like a high income earner. He was an engineer. He did well, but nothing crazy. And now he's like, one of the happiest retired people I know, and he umpires little league games.
That's
And
nice.
he has more money now in his retirement than when he retired. He doesn't even touch it. I have to tell him to go on vacations and go out to dinner. So the amount of money that you may have is, you have what you have, right? It's your lifestyle that you live and the happiness that you seek or that you have, right? Just because you don't have like, not everybody's going to make $1 million. Not everybody's going to make $250,000. But you have to save something. Otherwise, you have to plan for what life is going to look like when you maybe are collecting Social Security or something else,
Are
right?
people scared? Is it scary?
I don't. I think they should be a little bit, because we're just kind of getting through, like, the people that just retired, the generation. What generation was that? Boomers, right? They were kind of the last generation that was going to have a pension. So I'm not playing fear monger here, but so a pension is something that, you can put a little bit of your paycheck goes in there, and then maybe a lot of the employer's paycheck goes in there, and it's out of sight and out of mind, and you can't touch it until you're 60 or 59 and a half, whatever it is. And then you also have maybe a 401k, which is defined contribution, which means the participant puts most of the money in, maybe you get a match, right? The boomer generation had both of those, right? Like my dad.
Wow.
So our generation, well, we wanted our paychecks to be bigger, and defined contribution, or excuse me, defined benefit plans became kind of a liability for employers. So they got rid of those. And now people just have 401ks or defined contribution plans. So what am I saying? What I'm saying is the amount of money that you're going to have in retirement is on you to put away.
Wow.
There is no other bucket of money, and you'll have Social Security, I believe. I'm confident that we'll get that problem figured out. That's only going to cover a portion of what you need, right? So the rest of it is going to fall on you, and there is no pension switch that's going to get turned on. That is the thing I think most people should be conscious of. And there is only so much that you can put away in retirement, right? There's limits. So if you're going to live a certain lifestyle, or you want to retire sooner, you don't have as much time for things to compound, then guess what? You have to save more money outside of the retirement plans and after tax accounts and so on and so forth. I think our generation of people are not as well educated on that topic as they ought to be. And I hope they get more educated on it, because it's that simple, right?
Yeah,
We're,
that like they're
we're
like
looking at a
30.
retirement age of 62 versus our generation may have to work till they're 70.
Yeah,
That's
you're
the
seeing that
difference.
difference. I had this, I don't know if it's is it 70, or is it later than 7? Like I'm not asking you to give statistics or like any facts in that, but more intuitively, like in the wealth management world, is there like an unspoken feeling or nuance that hey, people are working later or older? Yeah,
Well, there's a bunch of variables working against that generation of people, right? The fact that they don't have a defined contribution plan, so that's a ding on the retirement income. The fact that everything costs more money, right? Inflation hurts the whole thing. So there's a couple variables that are really making the argument that is it 65 or 71? I don't know. Somebody could probably do the algebra and figure it out. It's probably just an Excel sheet, you know.
hmm.
But
Hey,
yeah.
last question on this. What do you think drives the most successful people? Um, like, do they think about retirement, or is it something else? When I say
No,
successful, I'll define
definitely
it like
something
capitalist
else.
wise.
Something else.
What I mean by successful is like, uh,
It's a
uh
sense of accomplishment. Yeah, I think it's not money. It's not retirement. It is a sense of pride in the work that you've done or that you're doing. And yeah, I don't think it's more complicated than that. It's definitely not money though. I'll tell you that. Look at Elon. He
Yeah.
doesn't have to be doing what he's doing. He could have distanced himself from all these companies by now, and like Bezos did, right? Bezos got tired of it. So he started to kind of walk away a little bit, distance himself. He's not the CEO now, he's just the chairman, blah, blah, blah. Elon's like, I want to start something else.
Mm.
They're both very successful. It's just two different, I guess, examples.
What do you say to the person? I got another fireball question that says Gates made a big mistake bringing in that genius to manage his money. He should have just held on to Microsoft. He'd be worth 4 trillion right now. He took some chips off the table. I saw a documentary. I think it's Phineas has these amazing documentaries. It's like Finaus on YouTube. There's these really brilliant documentaries on different financial people. And one of them was about the guy that manages Bill Gates' money. He runs a hedge fund for his family office or whatever.
Mm-hmm.
I have to send you the documentary for it. And anyway, recently Microsoft hit like this unbelievable to the point where Steve Ballmer, the CEO, is wealthier than Bill Gates. So,
Oh, hold
fleeting
on a
thought.
second.
What? Oh, yeah. No, he's not.
Well, so early 2000s. I don't know when it started. I could Google it, but I don't want to like while we're on here. There was a while where the federal government was suing Microsoft for antitrust
I
violation.
remember I was a little kid. I remember that. It was
And
like a
I don't know the timelines for Gates and the family office, but he was wealthy when that started, of
yeah.
course. And there was a period of time, and it wasn't 2 years, 5 years, it was a decade where that stock was in jail because they were dealing with the Department of Justice every day. They ended up getting out of it. I'm looking at the stock in 2001, $28.38. In 2011, $28.30.
Phew. 10 years, huh?
It didn't really start to take off until,
Wow.
2014.
Great, 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 like loop or finish your thought. Sorry.
Yeah, so I guess my point is, a lot of what Gates was doing with the foundation and hiring, somebody like that, that was philanthropy. And he didn't have a crystal ball. But of course, when have the benefit of hindsight, you can say, oh man, I shouldn't have sold this thing. But he had already made his money. He probably had already made his decision and was like, all right, I need to engage somebody to help me kind of spread this around and do some gifting, set up some trust structures, whatever it is. Like he's got all that, I'm sure. And whatever he has now at Microsoft, he has. But it's not like, he was watching this thing climb forever. There was a decade there where it looked like this company was going to get cut into pieces and sold for parts. So he did what
Um,
he had to do.
you have 10 seconds with the apprehensive listener that's saying to themselves, I'm not ready. I'm not ready to think about 40 years from now, 30, 20. In closing, what do you say to this?
The longer you wait, the less time you have for compounding.